occupancy rates are an astonishing 98%. Do you know what that means? A 2% vacancy rate. Most of America is going to be right around 6 or 7% vacancy rate, and this offers 2%. That means you put a house up for sale, rented, done. And home sales have gone up 12% over the last year. Forbes also says this bonus, and this is key, guys. Check this out. You can still buy properties at a fraction of their mid-2000 prices in good B neighborhoods for $70,000 to $85,000 that rent for $800,000 a month. Now, see, most people, when they analyze a property, your average real estate investor always wants to know, well, what's my return on investment? What's my cash flow? That's not what your millionaires and billionaires do. They don't say, what's my cash flow? What's my cap rate? You know how they measure their investments? Because I'm dealing with a couple guys right now. They gave me the rights to spend $13 million. Two Egyptians gave me the rights to spend $13 million to buy them investment properties. And you know how these millionaires buy properties? They want to know, what did it sell at the peak value and what can I get it for today? Because I got to be at least 50% below that value. They know appreciation is the fastest path to wealth. That's what they know. Buy low, sell high. Not what's my cash flow. That's why Forbes wrote it up that way. A fraction of the cost of what it was in the mid-2000s. Now, the other thing, I said, hang on, look at this. So this is true. We're not talking downtown. We're talking suburbs. $70,000 to $85,000 for a house. Cute little house in the area where you and I don't mind living in. That's the price my competition sells properties for. I sell them for $20,000 less. Which store is my favorite store? What is it? Costco. So I model my business after Costco. We move quality product in bulk at fair prices. Costco only raises their price 15% of what they pay for it. And we do the same thing. So when everybody else is trying to sell one property at $70,000 to $85,000, they'll sell that one. My thinking is I can get that investor to buy two and move them. And this is what we do. Okay? So let me show you a little bit about Cleveland. This sits on Lake Erie, which looks like a sea. It's huge. But this is downtown Cleveland right here. And so there's lots of places here that are great investments and places that I would say, ooh, don't go over there, just like any other metropolitan, right? But I focus my efforts right here. So see where it says Independence? Right next door to Independence is Garfield Heights, and I work this kind of semicircle, this backward C, going like this all the way up to Euclid. All the way through here. So the suburbs, and you can see a lot of these cities end with the word heights. Cleveland Heights, Richmond Heights, Shaker Heights. Anywhere it says heights, I'm pretty much investing in, right? So I'm all along these areas, and so with that, you're going to be looking at properties from about $50,000 on up. Most of our investors are spending in between $50,000 and $60,000 on a property. There are other pockets that I absolutely love that are going through a positive transformation, and we can pick up properties and sell them turnkey right around $40,000, and you're going to produce double-digit cap rates. Okay, it's pretty darn good. All right, so we're in the burbs. They're rent-ready, and houses starting in the mid-$40,000 range. We've got properties. Every once in a while, we'll pick up a nice little property in a nice little neighborhood. We've got one on our website right now, $37,000. Right? Shoot, it's probably what you paid for your car. You probably paid more for your car, right? And the car loses money, and the house makes money. Go figure. Okay. Strong blue-collar neighborhoods. We don't do any low income whatsoever. We're not in the hood. It's all about exit strategy. If you want appreciation, you want the ability to resell your property, you want the low vacancy rates, then we got to be in the areas of demand. Make sense? It's simple. It's simple math, right? So we have to have desirability. Desirability, number one, to you, desirability to your future tenant, and desirability to your future home buyer when you decide to sell it. You also have to take a look at the affordability factor. Affordability, number one, to you, what can you afford? Can you come out of pocket 50 grand? Can you come out of pocket for a loan to buy a property? What can you afford? Because I would never want anybody to wipe out their savings to buy a house. That's just stupid. I don't want anybody stressing, oh my God, I'm going to have a vacancy next month. I'm not sure if I'm going to be able to handle it. Then that's not for you. Don't want those type of investors. Okay? We got to build up to become that investor. So affordability factor number one, the investor. Affordability factor to the renter, and is it affordable to a future home buyer? So if you sit on this property for the next 7 years and you decide to buy it at 50 and want to sell it at 90 or $100,000, will it be affordable in that market? So we got to see beyond, not just what's happening today. And the answer with Cleveland is yes. Okay, so here's some perks. Right now, all the properties that we've got, turnkey, are 55% below the 2006 peak. That's phenomenal. Because a $50,000 property that I sell today easily sold for $115,000, $120,000 back in the peak of the market. Crazy.
How do you manage a rental in Cleveland from here?
I'll talk about it in just a moment. Okay? All of our properties are producing really about an average of about 12% on a house. You want multi-units? No problem. They'll produce a little bit more, probably somewhere all the way up to about 18% on our multi-units. But 10 to 13%. Now you got to remember, houses are not designed to create cash flow. They're just not. Like California, are you cash flowing today if you bought a house today? No, absolutely not. They're designed to appreciate. That's why we use appraisals for comparable sales. And then on the apartments and multi-units, we use what? Cap rates and gross rent multiplier to be able to measure the value of that property. But we've got this unique situation in certain markets across the states where we can buy houses that are cash flowing, and we can use that gross rent multiplier or that capitalization rate to figure out a value. But we also have recent sales to support that value as well. Okay, quick rentals, because we only have a 2% vacancy rate, but when I figure the numbers, as you can see on my website, I use a 5% vacancy rate, so I add a buffer. And it's a prime time to buy and hold because you have the opportunity to buy something, an acquisition at a low cost, and ride the wave of appreciation. I mean, how many of you in here wish you would have bought California properties back in 2010? Lots of them. You'd be sitting very pretty today. Well, you have a second opportunity right here. Don't think it's the only market. It's not. But it's the market that actually has all three ingredients optimized. Take a look at this house. Who thinks that's a cute little house? It's a cute little house, right? Good rental property, right? Only 3 of us? What's wrong with you guys?
I don't know. It's about $1.5 million in Santa Barbara.
$1.5 million in Santa Barbara? Is that true? So this is easy. Crazy, huh? $1.5 million. So I can go, like, I'm from Southern California, right? I was born and raised in Downey. I now live in Corona area. And in the Riverside County area, this house easy, $700,000-800,000, okay? I can go into low income areas, and then we're looking at about $500,000 in the low working class neighborhoods. But what we do is we pick up these properties, and when they're not off the MLS, we get them exclusivity through 2 small banks over there. We buy a lot of tax liens, we do the auctions, we do a lot of stuff to be able to pull these wholesale deals out so that we can cut out the middleman and offer you that spread there. So we go in, and then we turn around and make them rent ready. Now, here's the thing. Has anybody ever bought and fixed a house before here? Even your own home? Did you have to have city inspectors come and check your house 5 times to make sure that it's good? You did? Just by putting in paint and carpet? No. Okay, they'll do it if you're going to gut out plumbing and electrical, but if you're just going to put on paint and carpet and stuff, if you got to go get a roof, you have to pull a permit, but they're not going to come and check it out. Cleveland's different. Cleveland requires an inspector on your property. Listen to this. If I buy a property from you, you're the seller. You have to get what they call a point of sale. A point of sale basically means a scope of work. An inspector from that city is going to come to your house before you can list it, write up everything wrong with your house, whether it's something major to a flaking paint on the pedestal of your steps. And they'll mark it on the paper. Then they attach it to the house like a lien. And it's your responsibility, or my responsibility, to take care of it within 90 days. Now, I buy that property, I have to fix all those items within 90 days. Some are major rehabs, and some are just a little cleanup. During that time, the inspector will come out about 4 to 5 times to make sure you're doing the job correctly. Listen to this. Let's say the rehab project is $10,000. You know what the city wants? They want me not only to buy the house and pay $10,000, they want me to come out of $15,000 in bond money. So 150% of whatever the estimate is on that contract for repairs. So I gotta come out an extra 15 grand to put it in escrow. I'll get it back once I pass the point of sale. So a lot of investment companies like mine go out to Cleveland, they try to do this and they fail because they don't have the capital to do it. And they don't know how to do it. Not only that, the city requires, it's mandatory, that your contractor is licensed and bonded within that city. Not within the county or state, within that city. They want their finger on the pulse of everything.
Can they do owner-builder there?
What has that done to the makeup of the neighborhood? Has that raised the quality of the neighborhood?
So the question is, why are they doing this?
They want the
Because they don't want to be an armpit anymore.
money, right?
They're putting $19 billion into the city to revamp it up and refresh and make it all look new and become a second Silicon Valley, which is being called the hub of medical. They're bringing in millennials and baby boomers. They want to make sure that if they do their renovations, that the new owners of houses do the same.
So this is relatively new development.
It is. It started after the recession because when the recession kicked into place, what happened with contractors? Contractors would take a deposit and then they would run. Or they go and steal all the copper out of your air conditioning. And they said, not doing that anymore. Now, they want you to put that escrow money and do all this other crazy stuff.
Is that true also in the burbs?
It's only in the burbs. I don't do downtown
Oh, I
properties.
see, okay.
Think of any downtown metropolitan area with the exception of the urban type. Typically low income, right? Downtown LA, downtown. We don't do low income stuff.
But it's still
It's
tech-
only in the burbs. They don't do it in the city proper
I
area.
see.
Okay? So it's kind of crazy. So we go in and we fix it up to city code and get it past inspections. Now the investor, who needs that service that I'm talking about? People that want to build that rental portfolio. People that want to generate that income to go from, buying a $100,000 house to having $432,000 in equity. Well, it's the investor that needs experience on their side. A lot of people just don't know how to do it, nor do they have the time to learn. And you're only going to learn so much by, reading books and listening to tapes, guys. So you actually have to have experience to get out there and prove it. Listen, this is important, guys. Dan will test this. Linda will test. We're one of the only three in the area that pre-recession, everybody was in real estate. Recession comes along, everybody went back to work at Walmart or wherever they were working before. And who was around? Linda, Dan, and myself. Where did everybody go? Oh, they couldn't roll with the punches of the recession. They didn't know how to survive or thrive during the recession. And then 2011 comes around, and what happens? We got a whole new busload of real estate gurus on hand. Trust me, when a recession happens again, they'll go away, and the three of us will still be around. Yes, sir.
Could you bring an investor in Cleveland property with you, deed them in, and then deed yourself out without an actual sale?
No.
No way.
Title company will not allow that. Absolutely not. Any recording, they're going to question. It's crazy how tight they are. It's pretty interesting.
How does the point of sale, because I looked at Cleveland for a while, and one that, particularly in the Heights, Shaker Heights, Cleveland Heights, University Heights, the property taxes are really pretty steep.
They are.
But the point of sale inspections also seem to me to, when you're talking exit strategy, potentially add some stickiness to that, because if you're remote and you've got to clear a point of sale inspection, that can really bind the cheese of your exit strategy.
It absolutely can, but think about it. You bought the property with a point of sale inspection. That means everything is up to code, right? So we've got a property that's all up to code. Electrical, plumbing, everything has been done. Like I said, I don't care if it's a flake of paint. They're going to make you repaint that wall. You're a good landlord. You're going to keep it in good shape. So when you sell it, it's going to be in good shape, and you'll have to get a new point of sale. And of course, for job security, the inspector is going to find something wrong with the property, right? And as a landlord, you're going to have to fix it, and you're going to have to sell it. If you're a landlord that's a slumlord and you want it to go to crap, and then you got to try and do a point of sale, well then yeah, you're going to lose money on that property.
And not every one of these suburbs has the point of sale.
Not everyone, mostly the west side does not, the east side does. Okay? You mentioned Shaker Heights, very tight because it's a very large Jewish community over there, right? And that's where, out of that whole backward sea, that's where your most expensive properties are. Cleveland Heights, I love Cleveland Heights, and University Heights. So they'll all have a point of sale there. But here's the thing. You want to make money You want less headaches, be a good landlord. Simple, okay? If you want to get the cheapest insurance, not make any repairs, get away with try to skim away with all this other stuff, then you're going to pay for it in the long run. I don't mind. Look, the point of sale should make you guys feel happy because it's kind of like having a pit bull in your backyard that's not associated with me, right? You don't have to just trust me because now you got point of sale. And I would say 50% of our properties are Section 8. Now we got Section 8 inspections and Section 8 inspections that happen annually. So you have inspector after inspector watching over your property, plus property management. Versus going off, like in one of the other markets that I am, like Phoenix or Kansas City, Missouri. You don't have any of that. So you should feel a little bit more warm and fuzzy knowing that's going on. The investor that's looking to do these types of deals and using a service like remote rehab is the one that lacks time. Everybody here is probably working 40 hours a week, right? Wrong. Probably 50, 60, 70, 80 hours a week. When are you going to find time to put teams together and research and know which each little market does? You're not. See, a lot of people, when they look at numbers, they're looking at numbers just on the pro forma, right? What does it cost? What's my return? That's not how we look at numbers. We look at what's the state doing? What's the county doing? What's the city doing? What's the subdivision doing? And then how does it perform? See, we do a lot of extensive research. That's why we've been in business for a long time. And we crunch it all down. Because earlier I said I was a greedy investor. And if I don't do that, I'm not going to make the appreciation, the cash flow, the exit strategy, and utilize the tax benefits like I want to. Investors that desire a higher rate of return, so if you're not earning what you want, then you might want to take a look at buying some real estate. Investors that do not want to lift a hammer, but wants all the cash. So you can go out to another company and buy something turnkey, and you'll pay retail. It'll cash flow, and that's okay. You hold it for 30 years, you're going to make a ton of money, no doubt. Or you could be someone like me and utilize a service where you come in, and then we do the rehab work. We undervalue the property compared to the retail value. You gain a little bit on the equity side and on the cash flow side. So here's the benefits. We find the profitable deal for you. You guys, you're going to look on the MLS. You know what the MLS stands for? My listing sucks. So no, I'm kidding. Not today's market, but a lot of people are looking at MLS. The MLS is the primary data source for all properties being listed across the United States. So if everybody's looking on the MLS, who knows about it? Everybody knows about it, so why the heck are you looking there? Right? So you have to be a good wholesaler. You've got to know your marketing strategies, pick up properties that are undervalued. So we're going to be able to find that profitable deal for you. We perform all the research. Go to my website. You'll see the research that we do. Okay? We run the numbers for you. State, county, city, neighborhood. Done. Okay? In the house. We hire the contractors for you. Now, a lot of this is probably the biggest headache out of everything, guys, is contractors. They all want to get paid, but they don't want to work. Right? That's the thing. And how do you know if they're doing a good job or not? That's why the point of sale is so important. You got city inspectors making sure that they're licensed and bonded and following up with them with surprise inspections. Plus, every market that I'm in, I'm not like your typical real estate firm in California that utilizes a local service in the area, sells it to that investment firm, then a little bit undervalued, and then sells it to your retail. We cut everybody out. I have employees on every market that I'm in. I go buy a house, put them in the house, they project manage everything for me. Work for Black Belt investors. So I've got boots on the ground. When I say I have boots on the ground, they're my boots on the ground. Okay? We will review the work for you, keep you updated. We list the property for you to be able to get it rented. Property management will take over, and they will do their marketing and do all the proper screening to be able to get the proper tenant that you desire into your property. To me, we've built the best power team to work behind the scenes to help you become profitable that's going to do all the work for you. And you just collect the profits. Take a look at these guys here, okay? Fumi and Herb Tasaka just went on a tour with me this past year. And they said, we are so thankful that God has brought you into our lives. And they say that because I'm a Christian-based company. Like it or not, I don't care. But we're thankful that God has brought you into our lives. You have renewed our faith in people. It is so refreshing to be with good people who we can trust. Thank you so much for being you. Jane Garcia, real estate investor. Can't wait to buy my next property from Sensei and Black Belt team. Sam Sadat, runs the Beverly Hills Real Estate Club. We do quite a few things together. And he says, one of the very few I trust to consistently over-deliver. You know why? Because he doesn't allow people to come into his network to sell properties. But he allows me. Okay? So take a look at this house. $58,000 buys this house. This investor has it. It's just under 1,300 square feet. That doesn't include the basement. The basement will probably be like 900 to 1,000 square feet. 3-bedroom, 1.5 bath. Pulls in $950 a month in rents. Taxes are high, like Dave mentioned. You're looking, depending on which suburb you're in between 3 and 4% on property tax. Okay? If you're like, oh, it's a high tax. You're buying a cheap property. You're buying a $50,000 property. You're not buying a $500,000 property. That would be a big punch in the gut. Taxes are also tax deductible, by the way. Insurance starts at $620, 5% vacancy, 5% management. 5% vacancy, 5% maintenance, and then 8% management. And so that is a true net value right there that the investor will make $64.28 per year in net cash flow. Then we take that net cash flow, they paid all cash, we divide it into $58,000, comes out to 11% cap rate.
Where's the rehab cost?
That's included.
That's all in.
That's all included. When I sell property, includes all the rehab. Okay? So they are now earning 11% capitalization rate. Remember, a cap rate is taking the gross rent minusing out the expenses divided into the money that you put into the property. In this case, they paid $58,000. Here's another cute little house, right? We go in there, we just clean them all up, make them rent ready, pass all the inspections. And this property here is $60,000, but the investor came with a loan. I'm excited about this, guys, because every lender I've talked to since I've been in the Cleveland market will not loan on these properties because their threshold is $80,000. And they work on a commission basis. And anything below that's just not worth their time. And it doesn't matter if you do an $80,000 house or an $80 million house, the work is exactly the same. So they won't loan, but I finally got a lender on board that will do it at $60,000 their threshold. I'm excited about that. So a lot of our investors are, got to put 20% down, averaging right around 5% interest rate. So this investor comes in and buys a $60,000 house, puts $12,000 down, earning $950 a month, and then they got their mortgage payment, minus out all the expenses, they're earning $3,300 a month. That's a 28% cash-on-cash return. You are not earning that in your retirement account right now. Not at all. And you know what? That's just cash on cash. That's not including the appreciation and tax benefits that come along with it. That's just strictly the cash that's involved. So let's take these properties, and I'm going to wrap it up with this. Let's take these properties and put it into a very simple retirement plan. Something that we can all do. Now, I did simplify this plan on the numbers side so we can just go right through this. It's not complicated, so let's follow along. Let's say, for an example, I'm going to have 5 houses, okay? And let's say on these 5 houses, we acquire these properties with a loan. But just for simplicity's sake, let's just say we got 100% financing, okay? I'm leaving the down payment out of it. We'll just look at the loan as its true value. So on this property here, the loan amount or the value of the property is $80,000. That's what you purchased it for. It pulls in $850 a month in rents. Then we have our expenses off to the side. Your principal and interest payment, your taxes, your insurance. So your total outlay on this is $507. That's the expense. You minus it out of the $850, you're making $343 a month in income. Not bad. Okay, now I can pay my cell bill from, AT&T. Pretty happy about that. We buy a second property. And this property here is $48,000. Pulls in $950 a month. And with that, they have a principal and interest payment of $230, taxes, insurance, total outlay is $442, minus that out, and now you have $508. This is a Kansas City property, by the way, and this is a Cleveland property.
You're still buying B properties for $48K and renting them for $950 a month.
Absolutely, all day long. Okay? That's the big difference between me and the other firms. Go check them out. All right, we got another property, $100,000. Pulls in $900 a month in rents. Got all your expenses, $639. It totals up to be minus it out of your cash flow, you have now $261. Come over to your fourth property, and you do the same thing. Take the total outlay, minus it out of the rents of $1,100. By the way, see that $52,000 property? That is a property in the city of Garfield Heights that we just acquired in the spring, sold it to an investor for $52,000, and Section 8 is paying $1,100 on it. In fact, they're paying $1,133. For number's sake, $1,100 is easier to figure out, okay? And they are making $635 net profit off that property. Let me get through this. Write down your questions. Be happy to answer your questions, guys. Okay, then on our fifth property, we do exactly the same thing, the $75,000 property. We're now earning $338 per month. Now, we take each one of these properties, and we have these 5 houses that we purchased. We are now making a true net income of just over $2,000 a month. Who thinks that's good? Fantastic. You're thinking small. Let's think bigger. Okay? Now, instead of spending that money like, on your spinning rims on your Pinto or whatever it may be, let's take that money and start reinvesting it. Let's take it and start paying down the principal of each loan. Because your mortgage is typically how many years? 30 years. Mortgage is a Latin term that translates to what? To death. That's what it means. Mortgage. Get it? It means to death. Literally. They want to keep you on the hook forever. We don't want that. Okay? So let's take that $2,085 of your monthly income and start attacking the principal. So we take our income from each property, we go to Bank of America that's, got us locked up with that ball and chain, and we say, you know what? We're going to kick you to the curb. We're going to really beat you up and get rid of this mortgage. So remember, that first house is $80,000 with a total outlay of $507. Well, you know what ends up happening? We will take that 30-year mortgage and pay it off in 5 years, 8 months term. That's huge, guys. Got rid of 30 years and got it in 5 years, 8 months. Now what happens? We get rid of that mortgage payment, so our income increases. And now we're at $2,469 a month. We go to the same thing to property B. Wells Fargo, don't like you anymore, so let's get rid of you as quick as we can. So we apply all the rents to Wells Fargo's payments. And now we own 2 properties within 9 years, free and clear, increasing our net income to $2,900. Now, we've got 2 properties paid off. We hit tackle letter C here, and we go to the bank over there. I was going to say Washington Mutual, but they're gone, right? So Chase, we'll use Chase, and we get rid of Chase. We apply the mortgage and all the extra cash flow there on this $100,000 property, and now we have 3 properties that we now own free and clear within 11 years, earning $3,300 a month. We do the same thing in property number 4, and we're now earning almost $4,000, and we come to our final property doing exactly the same thing. That means we will own all 5 properties within 15 years, 8 months, earning $4,000 per month. Now, does that $4,000 look a little bit better than that $2,000 you guys shook your head to? Absolutely. That $2,000 is just a stepping stone. I'm going to have you hold your questions for me, okay? And I'll get to them. So now we're earning that $4,000, and all of those properties are paid off free and clear. What does that do to your net worth? It jacks it up, doesn't it? Totally increases it. So now we've got these free and clear properties. They're producing great net income. But here's your results. You got rid of the mortgage. You're now making $4,000 a month. You've increased your income by 500%. But we never took into consideration rent increases. Are rents going to increase over the next 16 years? Absolutely. But we just kept it at the original rates. Are we going to be able to take deductions on the property, depreciation and business expense? Absolutely. So we get to keep our hard-earned dollar. What about all that appreciation over the last 16 years? Did values go up? Absolutely. And you know what that does? It gives us options in life. Just going back to that senior couple where they owned their home free and clear but didn't own anything else. And she had to leave. But if she owned one more property, or 5 more, she can liquidate one and give the other 4 away to a charity or her family and leave a little legacy for them, a little starter. And this plan is just 5. Now, if this doesn't do it for you, then multiply it by 4 and get on the 20-30 year plan. Okay? Get on the 20-30 plan. Now, here's the value, the original purchase price is what we started off with. We had all 5 of those